Right, we're now very proud to present some exclusive research that Lombard Odier have done. We move into this powerful, insightful, and at times surprising research about entrepreneurs, what they're thinking, what their priorities are, their attitudes to wealth, and so much more. Presenting their exclusive research, here's Adam McConkey, Duncan McIntyre, and Stuart Wright from innovative bank and wealth and asset management business, Lombard Odier.
Good afternoon. I hope you can hear us clearly. My name's Duncan McIntyre and I'm the UK CEO of Lombard Odier. I am joined by two of my colleagues. The first, Stuart Wright, who is one of our senior private bankers covering entrepreneurial clients in our UK business as Geneva. Stuart, good afternoon.
Good afternoon, everyone, and thank you for taking the time to listen to us today. As Duncan said, I'm based in the UK, covering the UK market, looking after our private clients. I had a lot of experience of dealing with business entrepreneurs throughout their business journey, so I welcome the opportunity to speak to you this afternoon.
Thank you, Stuart. And I'm also joined by Adam McConkey. Adam is the lead portfolio manager on our small cap fund, which is called Volantis. Afternoon, Adam.
Afternoon, Duncan. Hi, all. Thank you for indulging us this afternoon. Yes, I run a team that looks after about 1.5 billion of capital investing almost exclusively in publicly listed smaller companies on the equity market for a range of clients. And I also chair the Quoted Companies Alliance, which is a representative body of smaller companies who are listed.
Thank you, Adam. And the reason for having both Stuart and Adam here today is that they represent two sides of the same important cycle. We've got Adam, who is really investing in and helping smaller companies and entrepreneurs. And we've got Stuart, who is looking after entrepreneurs who have sold their business or realized wealth from entrepreneurial activities. So we look forward to the discussion. Now, for those of you that may not know us, Lombard Odier is a privately owned private bank. We're managing around 300 billion of private client assets for some of the world's wealthiest people. And our UK business, which I'm responsible for, is based out of London, Geneva, and Zurich. So as I said, our business is really just looking after wealthy people. And when we did our research, the majority of those wealthy people are entrepreneurs. So we really wanted to do some research to find out what are entrepreneurs actually thinking. What are they thinking in a post-COVID, post-Brexit world? What are their thoughts about the business world, lessons they've learned, what are they doing with their wealth, and how do they see the outlook for the United Kingdom? So with that in mind, we wanted to make sure that we had this survey available for you this afternoon. So I think you're going to be sent it after this presentation so you can see it in more detail. But if I may, I will share some highlights with you from this presentation, and we can go through that with Adam and Stuart in a little bit more detail. Now, you might wonder why we've used ants on the front cover. As you will see, we are hugely committed to sustainability, and ants are remarkable creatures. And without them, many of us would not survive on this planet. And they never take a day off, which I think is something that resonates a lot with entrepreneurs in terms of their sheer work ethic. So if we were to look at this survey, what we did is we looked at a collection of UK entrepreneurs from across the spectrum. They are both entrepreneurs who are resident and domiciled and resident non-domiciled in the UK. And we looked at a range of ages and between male and female, and a spectrum of outcomes from those getting about 5 million up to 20 million and beyond. And about 60% of this survey is post-sale and 40% is pre-sale. So we haven't got a huge amount of time today, so we're just going to pick out 6 key themes from our research to make sure that you've got a chance to ask questions of us later. So if I look at the first statistic we'd like to pull out is the confidence level in the United Kingdom. So what we're seeing is entrepreneurs are saying 76% of them think the UK is well positioned as a centre for business and entrepreneurial activity in the next 5 years, not just now, but in the next 5 years. So, Adam, I suppose to you first, is this a statistic that surprises you? Is it? What do you take from this?
A couple of things, Duncan. Firstly, it chimes. The Quoted Companies Alliance has conducted similar surveys with the FDs and chief execs of listed businesses, and it's producing very similar data. But I think the really interesting data point here is that 5-year number. It just feels like the fog's clearing. We've got a clearer political framework because we've got a government that has a majority. We've got COVID becoming more manageable, and the Brexit fears are clearly been removed. And I think what's not yet widely recognised is just how big the hiatus in decision-making, given all those uncertainties, has been. We've looked at some of the trend data coming into the referendum in 2016. And if you extrapolate that trend data with all the caveats as to how accurate this might be, it leaves you with some big numbers of underinvestment, 11 to 12%, we reckon, of underinvestment in capital, CapEx, R&D, all that kind of good stuff. And so with that fog clearing, I think investors, I think entrepreneurs, even sponsored by the fiscal environment, are feeling free to start thinking and making decisions longer term. And there's a brilliant bookend on the news flow this morning. Everyone, I'm sure, probably remembers that Sunderland was the front page headline when Nissan says UK leaves Brexit, leaves Europe, and the future of that Sunderland plant's under threat. And today we've got confirmation that not only will electrical vehicles be built there, but there's a huge gigafactory to be built there, a new battery farm. So, you know, those purse strings are just beginning to be released with those kind of 5-year investment horizons.
Yeah, thanks, Adam. That pent-up demand question, I think the statistic is clearly very pleasing for us to see in this survey. There is the other side of it, which I'd like to look at. So 72% of our entrepreneurs that we surveyed are worried about personal tax rises in the future. Now, Adam, first of all, to you, from a kind of macro perspective, is this a theme that resonates, and is there a consequence in your mind?
Yeah, I think it's a very understandable concern. Clearly, one of the features of COVID is it's extended a lot of the inequity that's already in the system. And there are large groups out there that feel quite disenfranchised by a political elite, a corporate elite, and a financial elite going back a decade or two. We've also got an enormous amount of debt in the system necessarily to support the economy on the back of COVID. I'm surprised by the wealth tax piece, if I'm honest. I think everyone's accepting that we're going to have to pay more in income and corporate tax somewhere along the way. But I don't think a wealth tax agenda is really in train. That sounds a little bit of a legacy of a Corbyn government risk and a shift to the left. What I would say, though, is I think the policy framework is a little bit more forward-thinking than just we need to grab back some capital. I'm seeing market reform on the agenda through the Lord Hill review, which is about making publicly listed companies have easier and more cheap access to capital, making the UK a more attractive equity market to invest in. I'm seeing financial reform on the agenda post leaving the EU. So a less strict and not a less regulated, but a more considered approach to what banks can afford to lend. And there are some really interesting nuances in the current policy framework. And that decision to allow 130% capital allowances is clearly designed to put more investment in now, in the hope and expectation there's more profit later, in order that those earnings can tolerate a pickup in tax rates at a later date. So I think overall, we mustn't forget also that we're coming from a very low base on this in terms of expectations.
Yeah, Adam, good to hear the views of a bullish equity guy there. And if I go across the other side of the equation in terms of the client side, look, Stuart, you were looking after some of the UK's wealthiest entrepreneurs. Is the tax question an issue which is now coming up regularly?
Yes, I think it is. I think due to COVID, due to the fact that the UK government needs to bring in more cash, they've obviously been talking about increasing tax rates, both, as Adam said, at a corporate level and at a personal level. I think maybe the personal level, in terms of the rumours around wealth tax, have gone away. Certainly CGT, we believe, and I think all the experts are saying that CGT levels will definitely go up in the next year or so. And this has very much driven the IPO the initial public offering kind of market. And speaking to advisors around some of the entrepreneurs that I work with, they are now at the highest level in terms of the activity that they're seeing from companies looking to do partial or full sales. Yeah, I mean, the first 5 months of this year, I was reading an article on Bloomberg a couple of days ago, the first 5 months of this year, and it's seen a record level of IPOs in the UK. So yeah, I think everything's
Thanks, Stuart. And I think that brings the consequence of it, that maybe this is becoming a catalyst for a change. So I think we'll come back to that a little bit more if I can. If I move on, we're now 8.5 minutes into our 20-minute slot, and this is the first time we're going to mention Brexit. So I just put it out there as a warning. So we asked the question about what it felt like in COVID and Brexit, whether this has changed our entrepreneurs' business, wealth, or their location. So here are the headline statistics. 50% have changed their business strategy. 30%, 7% have changed how their wealth is managed. 32% have accelerated succession plans, and 30% have accelerated plans to move out of the UK. Stuart, to you first, if I may, does this resonate from what you're hearing from entrepreneurs in terms of what they're thinking and doing?
Yes, I think we could all say that we've all been personally touched by COVID over the last year or so, and we've all had more time to spend with our families. We've all had more time to think about the businesses that we're working in, or in your case as entrepreneurs, the businesses that you're running. You're thinking more about the strategic direction of the business. And I think this is a once in a lifetime event through COVID that has really made us take a step back. And in some cases, for maybe some older clients, think about our own mortality in terms of making sure that we have the right succession planning in place. So we've been doing a lot of work with our entrepreneurial clients around helping them with that strategic direction.
And Stuart, and if I push you, if I may, have you actually got some examples of this happening in your client book?
Yeah, I've got a good example that covers a few of the topics that are on the slide, which is, a gentleman who runs his own shipping business based in the UK. He has 3 children. His wife is European. He's looking at selling his business. His children aren't interested in going into the business. So what does he do? He's now decided to sell the business, but because there's no natural succession, that's really been his kind of driver in terms of selling the business. And we've been helping him throughout that process. And also he's now looking to move outside the UK. So he's really had this time to think about his business and selling it and moving and making sure that life after the sale is looking good as well.
And Stuart, do you think that decision or finding out that his kids weren't interested happened during this pandemic period?
I suspect it was there, but I suspect there's been more discussions within the family that have brought this to a head. And obviously there's always this, what we call handing over the baton to the next generation. And in this case, obviously, he's decided to sell the business.
Thank you, Stuart. Adam, from your perspective, I suppose the statistic that would be of interest is probably the 50% in terms of changing their business strategy. Any thoughts on that one?
Yes, spot on, Doug, and that's the one that stands out for me. I think Stuart's right. We're in one of those once in a generation moments and once in a career moment where there is a step. I mean, it's not just COVID. There's a degree of social, technological, economic, ecological, and political change around us. And I think when we step back, we recognise that COVID has accelerated a bunch of those trends that were already in train, and strategies have to catch up with that. It's clearly well trained what that means for the shift in the use of digital infrastructure and communication for the high street. But it doesn't matter what kind of business you are, your go-to market strategy is affected, how you engage and organise your supply chain is affected, and clearly how you treat your staff and where they work is affected. And then there's obviously a sustainability overlay there. So there's a degree of change here. I'd almost expect it to be higher, to be honest.
Interesting. Yeah. Well, look, certainly change is the maker of many. So if I can move on, given the interest of time, One other statistic which stood out to us is 56% of the entrepreneurs that we survey say lifestyle factors are the primary trigger for a business sale. Stuart, again, have you seen this happening during this period?
Yeah, I mean, for me, this is really critical. The more time that is spent, as the headline of this slide says, preparing the ground for a business sale, the more time that you can spend on that is time well spent. Because I think it's just a really critical. It depends on the client, and it depends on what stage they are in terms of whether they're in their 30s or whether they're in their 60s. But some of the clients I'm working with at the moment, they're looking to do an IPO in say 12 months' time, and we're working with their advisors, their lawyers and accountants, to actually put together some structures now that once they sell the business in 12 months' time, we would have done all the groundwork so they can focus on their business and we can focus on preparing the ground for the sale. So I think the more time that is spent on that, the better.
Thank you, Stuart. Adam, seeing it from your perspective, is this interesting in terms of what comes out of this?
Yeah, I think this is fascinating because this question actually sort of goes to the heart of a good chunk of the survey itself. We start with increased confidence in the UK. We've got increased concerns about the impact on wealth and income. And we've been talking about accelerated changes to strategy. To me, all of those are catalysts for increased corporate activity. For some, that means opportunity. And for others, that's a question as to, am I the right person, or do I have the succession plans to take this business forward, given the change around us? And so what we have absolutely seen is much more, a real burgeoning level of corporate activity as a consequence, not just IPOs, but increasingly companies that are listed saying, look, we're a great home for companies that are looking for an exit. And in that context, I think that emotional attachment to a business is a really, really interesting data point, because successful M&A is almost invariably tied up with culture fit. A successful outcome from the vendor from a financial perspective invariably is also tied up with an earn-out and a success, aside of the fact that the vendors tend to care passionately about their children. And that's how they think about their businesses, isn't it? So I think there's a sort of a forgotten point here about the value of equity, and you'd expect me to say this as an equity guy. And that's that equity is one, permanent capital. It's not temporary. It doesn't involve a change of ownership again. Doesn't involve a change of debt structure again. So it's permanent. It's permanent capital. And that's been much forgotten, I think, in recent years. And two, it's many shareholders, not few. And that's really important for continuity of strategy, not change of strategy, and change of control and change of parent. So I think there's a really, what we're seeing the equity market be very much part of the solution to a number of the concerns around the business sale, but also a source of exit.
We were disappointed, Adam, if you didn't see an equity bull story in there. But so if I can move on, given the limited amount of time, Stuart, we saw in the last slide that actually emotional attachment was one of the biggest blockers for people selling a business. I'm one of the entrepreneurs we saw described it as giving up their child almost when they sold their business. So there's an element of bereavement in this. But yet we see from this statistics that 3/4 of all the entrepreneurs that we surveyed were actually happier post-sale. Have you got any thoughts on this one?
I have, yeah, and I think again, just briefly, kind of the more time that you have spent preparing the ground, then maybe life after exit does look much better. But I'm working with one particular client who's in his early 30s. He's recently sold his interest in a fintech business in the UK, and we're kind of helping him with what does it look like after exit. I mean, he's passionate about being an entrepreneur. He is a serial entrepreneur, which I'm sure a lot of you are as well. But so we're helping him in terms of looking at angel investing opportunities that will motivate him after selling his business. He's also shown a great deal of interest in sustainable investing. So we're working on particularly around social sustainable investing. So looking at what he can put back into society And so it's really making sure that there's things that will motivate after the sale has gone through. And I think that's really key, because if you haven't thought about life after the sale, then it could be quite challenging.
And it's interesting because I think you can make the assumption you have to be at a later stage of your life to be selling a business. And Adam, I think you've got some views on this serial entrepreneur point.
Yeah, absolutely. I think there's a sort of a connection in terms of business cycle and what's clearly Stuart's field of expertise. What's clearly become apparent in recent years is the business cycle's got shorter. Companies can reach a degree of maturity and a critical mass and scale much more quickly than they have done historically. And even listed companies, shorter life cycles too. So if you can get in 3 to 5 years where it might have taken 15 to 20 years, clearly you've got entrepreneurs who've created wealth and shareholder value, who at 30-something are ready to roll the dice again. Then they're thinking still about wealth creation and not necessarily about capital preservation. And that, I think, I'm sure, and it's not my area of expertise, this is Stuart's area, that has to mean a different kind of wealth management advice and choices available to high net worths and entrepreneurs when they realise those returns.
I think that's absolutely right. Look, before Greg pulls the mic back from us, I want to raise two other points before we wrap up our session. In the survey, which you'll all get a copy of, there's some key lessons learned that the entrepreneurs are telling us in their words, and I'm sure these will resonate with many of you in terms of take your time and keep calm, do your homework, look after yourselves in this process. And so I would commend these thoughts to you. And I'll leave you with one final page, which is something I mentioned at the start we're very passionate about, is sustainable investing. And this statistic is interesting. So there's a gulf between the words and the actions. 72% of the entrepreneurs we surveyed have said they're really concerned about global warming, yet only 25% of them are actually investing sustainably. And I think you might see a reason for that on the right-hand side, where we would contest this very strongly, is 33% of them still believe that sustainable investing means you sacrifice your returns. Nobody is going to invest in something that sacrifices their returns. We believe this is probably one of the greatest investment opportunities in the world, and we're very happy to discuss that in more detail. We're putting our money where our mouth is. We've just endowed the first ever professorship of sustainability at Oxford University, and we're also the only business of our scale to be B Corped in the world. And if there's one tip to you entrepreneurs out there, consider becoming B Corped. I think it will help hugely in your positioning. But if you don't know what it is, I will leave you to look at that. And if we can provide you any support in that process, that's part of being part of the B Corp family. So thank you very much. And with that, Greg, I will hand back to you for Stuart and Adam, or I indeed, to take any questions that you may have from the participants. Thank you very much indeed.
Thank you very much for that research and your explanation of it. Amongst other factors, I'd just like to explore this. It seems to me that although you framed it at the start as there's a deal more certainty emerging, I think you could make a contrary argument, which runs along these lines, that Brexit, okay, it's decided, but it's yet to play out. The pandemic, we are right in the middle of this, the last stage, apparently, and even today there's a degree of caution from the Prime Minister about the pandemic coming to an end effectively on July 19th. There's clearly a huge amount of capital washing through the system, both corporately but also domestically, personally. You've said there's massive growth in IPOs. We also know at the other end of the scale there's massive growth in startup businesses. There's a lot of change at the moment. So how do you as a business attempt to interpret this and provide clients with the top level life-changing advice?
Okay, I think that if I may, I might direct, because that's a big question. But I think that in terms of the positivity compared to some of the views you were expressing, Adam, I think you've got some quite strong views on this. Is there anything you want to add on that?
Yeah, I think there are two questions in one there, aren't there? There's a question for how do you look after clients when you're on the wealth management side, and then the other question is how do you invest with all that noise around and change? And on that bit, which is the area I play, I think there are a couple of observations. Firstly, I actually think people have just been waiting and wanting to be optimistic. there have been so many reasons not to do something that a real fatigue had kicked in right at the end of Brexit. It almost got to the point where it didn't matter what the shape or colour of Brexit was. People just wanted to know, and once they knew, they'd be able to make a decision as opposed to not make a decision and defer a decision. And it's not just been about Brexit. COVID has clearly magnified that, right? But there have just been lots of reasons not to do stuff. Even the US presidential election, the uncertainty that creates. So I think there's a big behavioural piece behind that. The second point, which I think you're spot on about, is with that change, I think there is going to be clearly more divergence of outcome. And as an equity guy, that means I've got to be, and the team's got to be clearer in what the critical factors of success are as to who wins and who loses, because there is going to be more divergence of outcome than there is perhaps in the market as it currently stands, as you described, with the amount of money that's flushed into the financial system and support for companies.
Stuart, on the client side, how are you navigating those tricky waters?
I think for me, and this for me, it's quite a simple message that the closer that we are to our clients and the more time that we spend with our clients and their families and really getting involved in their businesses, then we're able to help them on the journey. And I think the way I see it is if we work as a team around the client being in the centre, then we can we don't get any kind of nasty shocks along the way, and we can make sure we have the right planning and the right people in place to really support the client on his journey from setting up the business, running the business, and then right through to the potential sale of the business. I mean, it sounds quite simple, but I think it's really key to have that.
Yeah, and to the start point, I wasn't intending framing this from a negative point of view. It's the other way around. There, as you say, there's such a potential divergence of outcomes, a huge range, essentially. That means there's greater value on interpretation, the exact work that you do. And these are fantastically and attractively testing times for us all. We've all got to figure out what's our best strategy. We've had a question from Annie Kelly, actually, on our team at Media Clash. She said, if I found it interesting to hear about legacy planning and your work with clients, is it perhaps slower to sell businesses post-COVID? Are you finding that, or from desire to deal, is it? How does that compare with previous times? Or decision to deal, perhaps?
Adam.
And I can give you a public markets perspective. I've been surprised how quickly we've seen activity return. You would absolutely assume that because you can't see the whites of the eyes, you have to conduct conferences on Zoom and not in halls, because you can't go and walk the floor on a factory setting, that the due diligence process gets slowed up. I think the decision making has been sped up. It's the due diligence process. Markets have a great way of finding a way. I've heard stories. I had a conversation with a company buying an asset yesterday in Northern Europe. I asked them exactly this question. And they'd actually got the auditors to fly drones through the factory in order to sort of check the assets are exactly as they say on the tin, as people say. So the decision-making process has sped up. The desire to do something has sped up. There's a little bit of a delay in executing, but net, been very pleasantly surprised how quickly things are getting done.
That's a fantastic story about the drones. I was quite taken by that. I guess one of the things that can't be done in due diligence to the same extent as previously is that whole kicking the tires in the sense of what a culture of a business might be like. If everyone's at home, there's not in many cases. But as you say, capital will find a way. There's a huge amount of capital out there. There'll be homes to be found. And it's extraordinary, that level of IPO activity that you cited. I want to bring up two points from your research. You've touched on both of these, of course. The Lombard Odier research shows that exits are nearly always take longer than expected, and often far harder emotionally than intended in the first place. What advice can you give entrepreneurs watching this about handling that process? It can be tough, right? It's a great outcome, but it can be a tough process.
Yeah, great. I think that is a very important question. One of the points of this survey, which I think has been very important for us, is that we clearly see a lot of these conversations from entrepreneurs telling us what that journey was like. and they use adjectives like bereavement, and there is a feeling of when you sell something you've given your heart and soul and everything to, that you then have this check in the bank, you have cash in the bank, but you feel like you've given up something. And so I think we need to be very cognizant of that journey. And I think Stuart's the one who has laid it out and seen it very clearly, where we need to frankly be holding hands with the clients during this walk. It is not something that can be done in very neat steps. It's got to be done linearly. And I think that's why we would encourage you, and Stuart, I presume you would agree with this point, is very strongly about having that team of advisors around you. So you're thinking about, and I'm no golfer, but it's not just about hitting the ball, it's about swinging to the ball and swinging right the way through. And I think that's very important, particularly as you go through the full sales journey. I don't know, Stuart, if you wanted to add anything to that comment.
I just have one kind of point to make where at the other end of the generation spectrum, I've got a client that's in his 70s that set up his business when he was 18, a construction business. And I've known him for a number of years, and he has really, really struggled to hand over the baton to the next generation. And honestly, it's really kind of eaten him up from an emotional perspective. I know him and his wife and his son very well. And I think my view is, had he done some planning and had he had the right people, I know I keep saying the same point, but had he had the right people around him, maybe that journey would have been easier.
Yeah. It's true. I mean, work defines largely, or perhaps sometimes even wholly, individuals, even more so entrepreneurs. They've created this thing. The metaphor of a child is a fairly obvious read across. It is a difficult and arduous process, but that's exactly why you need professional advisors with you every step of the way, of course. My last point is around the sustainability. You've got that dichotomy, which you've highlighted very clearly. It's incredibly important, and yet the portfolio is maybe 25% compared with, are actually allocated to sustainability, compared with 72% of investors who say they should play their part. The stand-back point, sustainability is rising as a factor on almost all indices. Do you expect this to continue, and are you advising your clients that this is an opportunity for your clients?
So I'm going to pass this one over to Adam to give the view from the investor side. But I think the short answer is yes, it's going to keep increasing. But Adam, I think you might have some views on that one.
Yeah, I mean, very specifically, I think it will become increasingly mainstream. There's a bit of a battle as we speak, a bit like forming a new credit agency industry for how we grade, and the indices are sustainability credentials of companies, and the indices are part of that equation. What I think that's really, really interesting in that dichotomy that's in the data is, and I haven't seen the demographics of the sample, right? But on one level, I suspect we've got an entrepreneur or an investor base who are a little longer in the tooth, who are thinking more about capital preservation rather than wealth creation, and so a little bit more risk averse as a starting point, rather than perhaps some of Stuart's examples of the 30-year-old entrepreneur. The other part is the sustainability agenda means very many different things to very many different people. And as a default, I think many will think it's higher risk because you're investing in a new technology, recognize that there's a lot of money chasing this agenda, so it might not be accurately or efficiently priced given where it is and the probability of success or failure. What I would say, which comes back to your point about mainstream, is there are a growing list of companies, and I think this is the bit that's really exciting and really misunderstood. There's a growing list of companies for whom the sustainability agenda, not even the reinvention of their business model, but the adaptation of their business model, is a source of competitive advantage. It makes them stand out. Now, they don't get the sustainability label, comma, yet, but they will grow faster and be around for longer and become more attractive as investments as a consequence. So I think that we're in that phase where that data reflects a number of different tensions as to what sustainability is and who it's being invested on behalf of.
Well, and as a corollary to that trend point you're highlighting, you'd perhaps expect that gap, that dichotomy gap, to narrow as the relative value of sustainable investments becomes clearer. The business models are clearer, the companies are more mature, the technology is more stable. So actually, over time, it should trend to the norm. Is that, or a form of norm? Is that broadly?
Yeah, and I think the point is that transition is the exciting bit. We're seeing that real transition happening. And Stuart, I think you're seeing that. I mean, give us an example of what of that.
Yeah, I mean, there's some really, I mean, the obvious kind of company that has done tremendously well is Tesla. But then if you look at a company, a Danish company that was involved in oil and gas called Ørsted, they have completely changed their business model. And this is maybe the route that BP and Shell will go down. And they now purely run wind farms. So, you know, they've gone from heavy industry and they've come out the other side, and they now are a completely sustainable business. And I think the work that we're doing internally is to try and find those companies and really understand the journey that they're moving on and the business model to become a more sustainable business.
I've let this run longer because it's a fascinating discussion. We very much appreciate the insights, the exclusive research. Just a few points in closing. I don't know if you saw it earlier, but Dale Vince was extraordinary when he was talking about the green commercial agenda. Obviously, he's speaking from an evangelist point of view, but it's becoming increasingly mainstream, as you've each said today. Please perhaps consider looking at that subsequently. And I think Duncan, you'll be on the panel later, so you'll be with Dale Vince, and you'll get to see, as it were, up close and personal, exactly how a green entrepreneur is driving value and actually continuing to mainstream it as a sector. Other last point is that we will, our company Media Clash, with the great success, which, and thank you ever so much everyone who's contributed to EntreConf, we will be launching a similar event for the sustainability sector in November as well. So, you know, that's all to follow. But for now, I would like to thank Lombard, Odier, to Adam McConkey, Duncan McIntyre and Stuart Wright for your time and insights today. Thank you very much indeed. Thank you.
Thank you very much. Thank you.
Very much.
Thanks.